Hey, good morning, options traders, and I hope everybody had a great weekend. And I wanted to just post a quick video about synthetics visualized. And the reason is I was speaking to another trader who said, this whole concept about synthetic positions is really confusing. There's a formula that you have to memorize, or you have to understand a fairly complicated derivation of where it comes from, and it's just confusing. So is there a way that you can visualize a synthetic position to help you to understand the formula? Because once you have the formula, then you're off and running. Now, let me also say, for anybody who's new, synthetics is a really important topic. It's going to help you to understand positions, locate risk, maybe potentially see trades that you didn't see before. In a lot of ways, it's like learning scales for a musician. They break down these positions and risk graphs into smaller components, help you to get different looks into the risks and potential rewards. So they're an important part of trading, but again, if you're having a hard time understanding the formula, let me show you a way to maybe step into it a little easier by seeing synthetics visualized. So first, remember what a synthetic position is, and if you don't remember, there are other videos in here talking more in depth about synthetics. But basically, it means that we have three basic assets. We have stock, calls, and puts. And any one of these can be created by a combination of the remaining two. So I know, for instance, if I pick stock, I know that I can synthetically create stock by using calls and puts. Now, that doesn't tell me if it's long calls or short puts or whatever, but I just know that stock can be made up of calls and puts. So we have to figure out what these signs are. And this is where the synthetic formula comes in. So the basic formula is that call equals stock plus put. That's one way to come up with it. But it's a little hard to either remember that or to figure out where it comes from. So here's a good way to visualize it. Remember that a synthetic just means that we are creating the same risk graph by using two of the remaining components up here. So let's start with the easiest risk graph, which is just long shares of stock. Long shares of stock, we have no bends in it. It's just delta 1, dollar for dollar up and dollar for dollar down. Now, let's take a look at a long put. So if we bought a $100 put, I'm not going to put any price with it, but we would get a bend right there at 100, which is where the strike is. Now, the first thing to notice is that the deltas from the puts over here, this red line leaning upward towards the left, these are negative deltas. And notice that they exactly mirror the positive deltas down here from the long stock. So if we combine these positions, if I bought shares and I also bought this $100 put, that all of this area here to the left would exactly cancel out. And again, that's just because they are mirror images. So I can tell that I would have 0 deltas over here to the left of 100 in the combined position. Again, the combined position being long shares in this long put. Now, what about to the right of the 100 strike? Well, over here I can see that we have 0 deltas as well. This red line is flat, but I've also got positive deltas. So if I have positive 100 deltas combined with 0 deltas, I should have, on a net basis, positive 100 deltas. So already I can see that if I use this strike as my dividing line, to the left will be flat, and to the right will lean up like this portion of the black line. It will be 100 deltas. So let's do that. Let's put these in our account. Let's buy the 100 shares of stock in black, buy one put option in red, and the combined position will look like this. It's exactly what we visualized from before. Now here's where it can get very easy to visualize your synthetics. Here's our long call, and this is what a long put would look like, just the opposite. Now the next thing to understand is that whenever you do a short position, you're going to just flip this. So this little horizontal axis right here at 0, just let the entire risk graph swing around on that axis. And so if this is a long put, this would be a short put. So now combine this with the long call. And if you do that, I've got a long call and a short put. And notice that when you combine these, that we've got 0 deltas to the left here in green. I've got 0 deltas to the right here on the short put. So there's really no effect. All of the risk right here is on this angled line right there, which is long shares of stock. So that's a real good visual, just backing up and understanding that if I take a call option and I overlay a short put, that I end up with just long shares of stock. And so all of this area to the left in green, of course, has zero deltas. There's no effect. Over to the right is also flat, so it also has zero. So there's really no effect here. All of the risk is just right here on this graph. That's the net effect. So this is what's left over. So the idea is that a long call and a short put will give you long shares of stock. Got delta 100 the entire way through. So if you can start there, then you're home free. Remember, as I've talked about in the previous videos, once you have the formula, you can figure out any of them. So the purpose of this video is to just show you an easier way for stepping into the formula. Visualize a long call, visualize a short put, and realize that is going to give you long shares of stock. So now we can figure out synthetic positions. So here's the formula. We're going to take our long call that we talked about. We're going to add a short put. That's what we visualized. And those two pieces give us long shares of stock. So once we have this formula, we can figure out any of them just using some algebra. So for instance, if we wanted to figure out what a long call is synthetically, see, I've got a long call on the left, but I've also got it combined with a short put. And I don't want that. I want just a long call. So to do that by itself, I've got to get rid of this minus p. So I can either add p to both sides, or visually I could just take this minus p, swing it over to the right, and when I do, I have to change the sign. It's got to become a plus p. So that tells me that a long call must be equal to stock plus put. So if we take long shares of stock and add a put, it will in fact give you the same risk graph as a long call. Let's try another one. Start with your basic formula that you visualized. Again, long call and a short put must combine to give you long stock. That's the key. So let's say we wanted to figure out what a short put is. Well, I don't have a short put by itself. I've got call plus a short put. So if I want just the short put by itself, I've got to get rid of this C on the left side. And that means I need to subtract C from both sides. Or I could visualize it by taking the C, just pushing it right over here to the right. And when I do, I've got to change the sign. So that becomes S minus C. There's our long stock and there is our short call. So if we have long shares of stock combined with a short call, that will in fact give us a short put. So some of you might recognize that long stock and a short call is a covered call. So there's kind of an interesting insight into risk. Some people think that a covered call is very safe, but your broker is going to require the highest level of option approval to do a naked put. So they are exactly the same, but it also could depend on the assumption of risk, whether the shares were in the account first or not, but we'll have to save that for a future video. But for right now, I just want you to step into this formula easily. And this is the key insight. Visualize the long call, short put gives you long stock, and from then on, it's just simple algebra. So I hope that helps. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.